now joins in on the show to talk about numbers as well. Thanks so much for taking time out. Let's begin with trends in the motor segment this quarter. Would you say that the growth is back, or do you seem a little bit guarded?
So if you look at it, I think insofar as motor is concerned, for us, the trend line seems to be very, very encouraging. For example, in quarter one, our growth in motor was roughly at about 5%. In quarter two, that number has kind of inched up to almost close to about 10-11%. And relative to the market, I think we have been able to substantially narrow down the gap insofar as growth in that segment is concerned. The reason for us to be slightly still growing lower than the market is if you look at the combined ratio, which is the results of what we underwrite. For the industry, motor combined ratio still continues to remain elevated upwards of 120% plus. So hence, to that extent, is where we are still kind of taking a guarded stance. Having said that, I think the trend line seems to be looking very, very encouraging. And more importantly, I think we will obviously also wait for the rest of the year in terms of how the expense of management play out for many players in the market. Because that's something, if you look at, for roughly half of the industry, participants are having their expense of management in excess of the regulatory thresholds. For ICICI Lombard, where we are well within the threshold, and hence to that extent, as and when that starts to see getting corrected, we would obviously be able to see incremental opportunities.
So you've increased pricing. Has the competition increased pricing, especially in the motor segment as well?
So I think again, if you look at it, motor as a segment for ICICI Lombard towards the beginning of the calendar year is when we had started to effect small amount of price increases. These are single-digit price increases that we have seen. And as I said, many players in the market were very aggressive over the last 18 to 24 months. Many of them have started to calibrate their growth numbers. Given the higher levels of combined ratio that I spoke about, of roughly in excess of 120% for the market. And that's something that is not sustainable. So hence, many mid-sized, relatively large-sized, as well as small companies, they all have kind of started to calibrate growth, which is definitely very, very positive from an overall market development standpoint. At an industry level, I would not necessarily say that people have taken price changes, but we do see instances of companies calibrating growth either by increasing small amount of pricing, or more importantly, as I said, also to kind of look at the overall expense of management.
So how do you see the loss ratio playing out, and how comfortable are you on the risk?
I think from an ICICI Lombard standpoint, one of the biggest strengths that we have is our ability to slice and dice portfolio in terms of various risk segments. And that's the basis on which we have always balanced growth with profitability. And hence, to that extent, even when you look at motor, of course, what we keep saying is to definitely refrain from looking at quarter to quarter numbers, because there could be a lot of elements that could go into quarterly outcomes. Rather, a better thing will be to look at more yearly numbers in terms of the way how the loss ratio trend lines could play out. Specifically in the context of the motor line of business, for, let's say, it has got two components, motor own damage and motor third party. On own damage, I think the loss ratio range that we are comfortable in terms of underwriting is between 65 to 70%. And similarly, third party, again, if you look at the full year numbers, that broadly has been operating at the range of 70% or thereabout. So again, that's a range that we would be comfortable in terms of underwriting and risk selecting portfolio segments. But having said that, we would again not look at just one of the components of underwriting, which is in terms of the loss experience. We would obviously want to look at it more in terms of the overall combined ratio for the segment and for the company as a whole, which is where we have again talked to the market to possibly get down to the objective of combined that we have laid out by end of next year, which is by end of FY25. We would want to see our combined ratio for the company as a whole going down to 102%.
Also wanted to understand about how the two-wheeler segment has been shaping up. Because last time we spoke, you said that it was doing better directionally. Is it now looking substantially better?
So two-wheeler again for ICICI Lombard has been our inherent forte. And that's where roughly 1 in four two-wheeler insurances that happen in the market is predominantly insured by ICICI Lombard. And hence, to that extent, that segment is something, if you look at from an overall premium contribution, out of the overall motor line of business, two-wheeler for us contributes roughly about 27-28% of the overall mix. And that's broadly been the levels at which we have seen the mix of two-wheeler getting contributed. If you look at in terms of market demand, while on the private car side, the demand seems to have largely come back, two-wheeler, at least I'm sure when you also talk to the OEMs and in general when you're trying to find, and when we also do our own, let's say channel checks, clearly we see that still things are not necessarily out of the woods insofar as two-wheeler demand is concerned. Possibly it will take maybe another couple of quarters for things to come back. Having said that, as I said, for us, two-wheeler inherently has been our forte, and hence we continue to drive growth to that through that particular subsegment of the motor business.
Sure. Gopal, tell us what's happening with the health segment as well, because growth has been good this quarter. But going forward, what is the expectation from both individual as well as group segments?
If you look at in terms of what I had spoken even last quarter, for us, both corporate health and let's say individual or retail health, both of them are preferred segments of opportunities. And on both the segments, we have had industry beating numbers. For example, on retail or individual health, we grew by almost about close to 19-20%, whether you look at quarter two or half year numbers. The industry growth has been closer to about 18-19% or thereabout. So clearly, we have been able to beat the industry numbers when it comes to individual or retail health. And that's an area, if you recollect, we have been talking about making continued investments in building our distribution force, which predominantly happens through the agency distribution. And that number, if you look at it for quarter two, the retail health agency growth has been upwards of 21% or thereabout. So we are very, very excited with the way how the distribution investments are playing out on the retail health franchise expansion. And because of which we have been able to grow faster than the market. Our market share has slightly inched up. We used to be less than 3% market share in retail health indemnity. Now that market share is slightly upwards to 3.1% or thereabout. But having said that, I think, as I said, we have been able to grow faster than the market on the retail health front. On corporate health, I think the outcome is pretty much the same. Again, we have been able to kind of beat the industry insofar as the overall growth percentages are concerned. The good news is it has been across the board increase that one has seen. When I say across the board, it has been a growth that has been contributed by increase in volumes. It has been a growth contributed by increase in price. And equally, it has been a growth that it has been contributed by accretion of market share. So it's an all-round kind of an increase that one has seen on the corporate health side.
Now, your loss ratio on health continues to rise. Are there any concerns with respect to that? Where is it that you see your loss ratio for the overall health segment stabilizing?
So again, as we keep saying, again, when you start looking at numbers on a quarterly basis, obviously it could sometimes lead to a, let's say, misleading outcome. Primarily because what happens is in quarter two is largely periods of monsoon, when you generally get to see relatively higher incidences of health ailments. And hence, to that extent, you will possibly see, again, this is not just a quarter two phenomenon of this year. In general, when you look at quarter two of historical periods, you will always find the loss ratios to be slightly elevated than the rest of the quarters, which tends to get normalized as we head into the subsequent quarter three or quarter four, which is why, again, when you look at it on a full year basis, as I said, insofar as the underwriting of this particular segment is concerned, I think we're very, very comfortable with the way we are doing our underwriting and risk selection. The good news is a majority of the portfolio on the corporate health side is relatively mid and small sized corporate health accounts, which ensures that we are able to get a reasonable price. And more importantly, we are also able to kind of retain the accounts for a very, very long period of times. And hence, to that extent, to answer your point, I think we are quite comfortable with the loss ratio range, which we have generally spoken to again to the market to be around that 94-95% levels, because here inherently the loss ratios will stay elevated, but the relative cost of acquiring this business is a low single digit number, which is why on balance, I think again from a combined ratio perspective, it fits within our objective, and hence we don't see any challenges insofar as writing this segment is concerned.
Okay, and you also have spoken about how your expenses of management are likely to change the game this year. And still, despite that, last quarter you suggested that two-thirds of insurers don't actually meet the EOM guidelines. So tell us a little bit more. What is actually happening at the ground level? What kind of traction is it that you expect the regulator to take, or what kind of action are you expecting in case of non-compliance of EOM?
So I think again, when you look at public numbers, so that two-thirds of the company was for the last financial year. Now we have the quarter one numbers for the players in the market. The trend seems to be kind of largely similar, which is more than half of the industry participants are operating at an expense of management threshold, which I said is well above the threshold of either 30 or 35%, as the case may be. I think insofar as the regulatory action is concerned, again, if you look at the EOM guidelines, the regulator had given them a glide path for companies which are above the threshold to meet the EOM guidelines within those stated glide path. But having said that, it's been just a couple of, we will have to wait and see how quarter two numbers play out for most players in the market. But the regulator will obviously wait and possibly see the trend line over the next one or two more quarters, and possibly see at the end of the year in terms of how many companies are still operating at thresholds which are over and above the laid down EOM threshold. And I'm sure, given the thought process with which the regulator has come out with these guidelines, they would obviously start taking possibly severe steps against companies which are continuing to operate at levels which are higher than the laid down guidelines.
Now let's talk about the change of guard there. Bhargav Das Gupta, who has spearheaded the company for nearly 15 years, moves on. What changes?
From an ICICI Lombard standpoint, for us, management succession is something that we actively engage in. Not just now, not the fact that Bhargav's term was coming to an end, but even otherwise, at a management level, succession is something that the board and the NRC actively engages in. And hence, to that extent, whenever any of these situations entail, then to that extent, there is enough and more leadership depth that we have both within the company and within ICICI Group. And in this particular instance, I think the good part is, I think the NRC and the board found Sanjeev, who has been a part and parcel of ICICI Group and with ICICI Lombard since 2015, spearheading the retail division. He is the one who would now take charge as the MD and CEO. So hence, to that extent, I think it has been extremely smooth transition, and it indicates the leadership depth that the institution has created over a period of time. And hence, to that extent, the transition is very, very seamless. And insofar as the objective of the way how things will get played out, I think it will start. ICICI Lombard has always been kind of driving growth with profits. And even with this leadership change, the larger underwriting philosophy of the thought process in the way of the businesses will be underwritten will continue to remain the same. And hence, to answer your point, I think it has been a very, very seamless transition.
All right. Thanks, Gopal. Really appreciate your time.